Hello and welcome. Today, we're going to break finance down to its most basic, most powerful ideas. And look, these aren't just for textbooks. These are the concepts that shape everything from global markets to the choices you're going to make for your own future. So let's jump right in.
When you really get down to it, all of finance, and I mean all of it, is trying to answer this one simple question. When a company says it's going to make profits in the future, or when you promise yourself you'll have enough to retire on, how do you know what that promise is really worth, right here, right now?
And that's the whole game. Seriously, forget the super complicated spreadsheets for just a second. Everything we're about to cover, from the simplest tools to Nobel Prize-winning ideas, is really just a way to solve this one puzzle: how to turn the value of tomorrow into the dollars of today.
Okay, so to figure out the value of those future promises, we need a toolbox. And the very first tool we have to grab is the one that deals with time itself. Because in finance, time literally has a price tag.
This is such a powerful idea. Think about it. A dollar you have in your hand right now can be put to work. You can invest it, it can start earning interest, it can start growing immediately. But a dollar that someone promises you next year, well, it's just a promise. It's not doing anything. That lost potential is exactly why a dollar today is always more valuable.
And here's where the magic really happens. This is the power of compounding. See, that first $5,000 doesn't just earn a little interest. The interest it earns then starts earning more interest, and it just snowballs. And check out the acceleration here. It takes a full 18 years to double your money, but then it only takes another 12 years to add the next 6,000. That's compounding in action.
But, time is only half the story. A promise isn't just about when you might get paid, it's about if you'll get paid. And that if, that big uncertainty, well, that's what we call risk, and it's our second essential tool.
This leads us to one of the most unbreakable rules in finance: the link between risk and reward. They're two sides of the same coin. If you want a shot at a bigger payout, a higher return, you absolutely have to accept a bigger chance that it might all go wrong. It's the ultimate no free lunch principle.
So let's make this real. A government bond, it's about as safe as you can get. The chances of you not getting your money back are incredibly low. But because of that safety, the return is, well, pretty modest. On the other hand, a hot new tech startup, it could be the next global giant and make you wildly rich. Or it could go belly up in 6 months and you lose every penny. That's the trade-off right there.
And this quote just nails it. This whole idea isn't just for giant corporations, it's deeply personal. If you're 20, you have decades ahead of you. You can afford to take on more risk with some of your investments because you have so much time to recover from any bumps in the road. See how time and risk are always doing this little dance together?
So, if we have to take on risk to get any kind of decent return, what's the smartest way to go about it? Well, the single best strategy is a word you've definitely heard before, but it is so important it's worth saying again.
Right. It's that classic advice: don't put all your eggs in one basket. That's diversification. By spreading your money across different kinds of things, like stocks, bonds, and even just cash, you're cushioning yourself. If the stock market has a terrible year, your bonds might be doing just fine, and it helps smooth out the whole experience.
Okay, so we've got our tools, we understand time, we understand risk. Now, let's put them to work on a huge question, one that literally won a Nobel Prize. How do you figure out what an entire company is really worth? And we can actually break it down with a pizza.
Just imagine a company's total value is one big pizza. Now, you can slice that pizza up a couple of different ways. You can use equity, which is like selling slices to different owners, or you can use debt, which is like borrowing money against the promise of future pizza. So the big question is, does changing how you slice it actually change the size of the whole pizza?
And here's the shocking, Nobel-winning answer. In a perfect world, no. The M&M theorem says the total value of the company, the size of the entire pizza, doesn't change one bit. The mix of debt and equity just changes who gets to claim a piece, not how much pizza there is to go around.
Of course, we don't live in that perfect theoretical world, do we? We live in the real world, and the real world has taxes, and this changes everything. Because companies can deduct the interest they pay on their debt from their taxes, it's kind of like the government is giving you free toppings on your pizza. This tax shield means that using debt can actually make the total pizza more valuable to investors.
All right, let's move on to our final and maybe most fundamental principle. This is the law that underpins everything else we've talked about. It's the force of gravity that keeps the entire financial system from flying apart.
You have heard this phrase a million times, I'm sure. But in finance, it is not just a clever saying. It's basically a law of physics. It's enforced every millisecond of every day by millions of people and computers all around the world.
So, what is a free lunch in financial terms? The fancy word for it is arbitrage. It means a guaranteed, risk-free profit. Imagine a stock was selling for $10 in New York and $11 in London at the exact same time. You could instantly buy it in New York and sell it in London for $1 of pure profit with zero risk. But in the real world, these opportunities vanish in the blink of an eye because someone always gets there first. So, because everyone is constantly on the hunt for these tiny free lunches, they get eliminated almost instantly. And what does that constant pressure create? It creates the law of one price. It means a share of a company has to cost the same thing everywhere in the world once you adjust for currencies. This is the glue that holds global markets together.
Okay, let's tie this all together with our 4 cornerstones. First, time is money. $1 today is always more powerful than $1 tomorrow. Second, risk and reward are forever linked. You want high returns? You got to take on more risk. Third, cash is king. The real money a business generates is what truly matters, not just the profits on paper. And finally, number 4, there's no free lunch. The market is just too fast and too smart to leave free money lying around.
So, we've seen how these core ideas are used to value companies worth literally trillions of dollars. But here's the real takeaway. How can they help you value your own future? Because when you really understand the price of time, the cost of risk, and the trade-offs you have to make, you're not just learning finance, you're learning the language to make some of the most important decisions of your life.